think there's multiple reasonable ways to define liquidity, but basically what you're looking at, domestically speaking, is broad money supply growth happening or not? And where are the sources of it coming from? Is it from bank lending or is it from fiscal deficits? And then two, what does the international situation look like? Because if the dollar gets really strong, then all the dollar indebted entities around the world get generally squeezed because their liabilities are hardening relative to their cash flows. On the other hand, if the dollar eases, generally speaking, that's like easing their liabilities compared to their cash flows. So some combination of the quantity of money and then also specifically the dollar in relation to other currencies. And the way to kind of put that together, the composite, is to say what is global broad money when you then translate into dollars, because then you can map out the various magnitudes of those things. So if the dollar is strengthening, but the money supply is going up rapidly in a bunch of countries, then maybe that second factor is a bigger positive component than the strong dollar. So you kind of put those together and see what is the general direction. And we've generally been in, 2022 was really negative for liquidity. So 2020 and 2021 were like super across the board amazing for liquidity. And then 2023 and 2024 were like recovering from that negative liquidity environment and still good enough liquidity to be pretty good for attractive assets. And so far that seems to be the case in 2025 as well. And basically these things are moving around more. And therefore any asset that's correlated with liquidity is going to be more correlated with other assets that have that similar component, because liquidity is just such a big factor in this kind of post-COVID or like fiscal dominant environment. I think that they are one of the remaining levers that is available. Because if you look, generally speaking, foreign central banks on net have not accumulated new treasuries for like 10 years. Now, some foreign non-central bank entities have, but still not at the rate of treasury issuance. So overall foreign percentage of treasury holdings has gone down. Most of that's top-down decisions, like China's central bank deciding, it's no longer an interest to keep accumulating treasuries like we have been. But from a bottom-up perspective, there's still very strong demand for dollars globally. If you go to like the streets in Cairo, people want dollars. Same thing for a lot of other markets. And stablecoins are another mechanism for people to get access to dollar proxies in pretty convenient package on their phone and outside of their local banking system, as long as they're not in a sanctioned place where even the stablecoin issuer itself tries to, stop them from using it. And stablecoins right now are big, but we're talking like a $200 billion market, which is like a couple months of deficits. And so in order to actually make a dent in US kind of dollar dominance and treasury demand, that number would have to 5x and 10x from here, get into the trillions. But that is a vector where the US can keep pushing dollar dominance. Now, ironically, that comes with cost, because we talked about how the trade deficits and dollar dominance are somewhat in opposition. Because if that keeps the dollar artificially strong, that puts ongoing pressure on low margin American manufacturers, all else being equal. And so that does create those imbalances. But that is like an ongoing lever they have. As far as his comment on interest rates, it's important to note that most stablecoins prefer to hold T-bills because they want their asset duration to mostly match their liability duration, which is practically, super short. You can pull money out of stablecoins pretty quickly. And so they have to be careful about having too much duration in their mix. And so generally speaking, it's more of a demand for T-bills than T-bonds. That has only partially to do with the Fed's balance sheet. So when they do QE or QT with non-bank entities, that does affect broad money supply. So some of that reduction there in 2022 was related to the Fed doing quantitative tightening. Their ongoing quantitative tightening is also somewhat suppressing current M2 growth, but they're by no means the only variable. Other variables include things like how much are banks lending, including the US fiscal deficit, and are banks buying it or are non-banks buying it. And so you'll generally see a lot of assets were correlated with that over this period. Now, it's not to say that that correlation exists strongly in every environment. So on that chart, for example, it's a smooth upward trajectory all through the 2010s in terms of money supply. And yet we know there were some pretty big bumps along the road of things that were happening in that time. Like when Powell was hiking rates back in, 2017 and then ran into like liquidity issues and corporate credit and then got more dovish. There were other factors impacting that. Also, the 1990s had very low money supply growth. And of course, that was a very good time for US equities. Peak bullishness, peak demographics, pretty high monetary velocity. So the economy is doing a lot of work with that money. And so it's not to say that that is the only variable that matters across time. but that especially in an environment where, fiscal's running hot, so loose fiscal policy, generally stimulatory fiscal policy, but then tightening Fed policy, when those things change relative to each other and they're both relatively big factors, that makes a big difference. So in 2022, both the Treasury and the Fed were generally draining liquidity. That's why that was such an awful year for pretty much every asset. And then we started to see the Treasury offset some of the Fed stuff after that. And so at least in this environment, I do think various measures of broad money supply and adjacent types of things are actually pretty likely to remain correlated with asset prices. It's been positive to see this consolidation kind of work its way out. I probably thought the consolidation would last a little longer. I'm glad it's not because I'm long gold. We've seen a little bit of rotation in buying. So before it was mainly foreign central banks and people in China and elsewhere buying. Now I think we're seeing a little bit more North American purchases that are supporting it. And main difference between gold and silver is a lot of large entities like central banks buy gold, whereas they don't really buy silver. In addition, generally speaking, if someone is into like hard money and precious metals, gold's the low volatility one, and then they get into either silver, platinum, or miners for their higher volatility exposure if they're bullish on the space. And now with the size of Bitcoin and to some extent other cryptocurrencies, that market's more fractured now. So I would say that Bitcoin has not really competed with gold too much because it's not really competing with the same types of buyers. Now around the margins, it has competed, but I would say it's competed with silver and gold miners more because you're capturing kind of a hard money enthusiast with high volatility tolerance. That's a little bit more of a competing market. So I think that the options for higher volatility is a little bit more fragmented. So I'm not surprised too much to see gold kind of have a bigger breakout than say platinum or silver or the miners. I still think long term this has room to run because central banks around the world can say I like to hold assets that are not seizable unless like we're literally invaded, and there's more and more currencies having problems. I mean, the euro currency doesn't look structurally good. We already talked about US fiscal dominance, Canada's currency, China's currency. I mean, around the board, gold looks pretty attractive compared to most currencies. And so it's not surprising that a lot of entities buy it. We've not really seen an uptick in inflation expectations too much. It's mainly just that there's a lot of issuance. There's reduced appetite for it. Generally speaking, when you have a strong dollar, you get worse foreign appetite for treasuries because they're more in currency defense mode. They're more likely to be shedding assets to defend their currency than they are to print money and increase their reserves. A big factor will be to see what happens later this year with the new Treasury Secretary, because he's been critical of the prior Treasury Secretary for issuing so many T-bills. And while they have debt ceiling discussions underway, he's been more inclined to keep that policy in place despite previously criticizing it. But presumably when they get past the debt ceiling, he's going to try to term out the debt more, which means all else being equal, more issuance of duration. I'm pretty mixed on bonds right here. I generally think that they're certainly more tradable than they were. I mean, I've been a structural bond bear since at least 2019, and I'm certainly not as bearish on bonds here as I was when they were, super low yielding. But I still see less compelling reasons to own the long end of the curve compared to gold, compared to the middle of the curve, the short end of the curve, or tips, unless you specifically have like a 6-month trade that you're bullish on yields for a given period of time. I am less risk on than I was for 2024. The election, for example, a lot of the benefits are assumed, but now we have to potentially deal with the cost, the higher cost of reshoring, the ongoing uncertainty around tariffs. We're not sure what's going to happen with some of that. And so I'm kind of mixed. Like, I think liquidity looks pretty good overall. The deficits are still big. PMIs, like purchasing managers indices, if anything, are rolling back up more recently. Banks are not really lending but they're not tightening lending standards like they were in, say, 2022, 2023. I think it's an environment where you do have to be careful about valuations. I think that, paying 60 times earnings for Costco is unwise. I mean, it doesn't mean that it has to change in a year, but if you kind of look back and say, what in this environment was dumb? I think it'd be things like paying 60 times earnings for Costco. But I do think that there's plenty of opportunity out there in a variety of asset classes. And I think we're probably going to be still kind of running hot in 2025. I think the fact that energy is already way off its highs, like a lot of the Russian energy found its way to market after the initial turbulence. So it matters less than it, say, would matter if it just ended quickly in 2022. But all else being equal, it's good for supply chains, it's good for energy. And this is, for most investors, probably a base case, which is that Trump has made it clear that in his term, he wanted to end that war, which all else being equal, good for markets and takes out some of the energy tail risks that have been in place.